The stock market. You hear about it all the time, right? It sounds incredibly complex, like the secret world of charts and numbers that only experts could understand. But what if I told you it all started with giant sailing ships, exotic spices, and deals being made in smoky old coffee houses? Well, today we're going to pull back the curtain and demystify the whole thing, right from the very beginning.
So let's jump in a time machine and go way, way back to the 1600s. You've got the Dutch East India Company, which was an absolute global powerhouse. We're talking hundreds of ships sailing all over the world, trading things like gold, porcelain, and silks. Seriously, think of it as the Amazon or Google of its day, a true mega corporation.
But, and this is a huge but, there was a massive problem. Funding these incredible global voyages was just unbelievably expensive. A single trip cost a fortune, and there was absolutely no guarantee that the ship would even make it back home. It was a crazy financial gamble.
So their solution was, well, it was brilliant. To get the cash they needed, the company went to regular private citizens and offered them a share. It was basically a tiny piece of a ship's potential profits. This simple idea let them spread out that immense financial risk and, of course, the potential reward.
And just like that, by selling these little pieces of paper in coffee houses and down at the shipping ports, the Dutch East India Company pretty much accidentally invented the world's first stock market. It was a totally revolutionary way to fund big, risky ideas.
Okay, so how does a 17th century idea about ships translate to today? Well, let's fast forward a bit. Imagine a brand new company. Let's say it's a cool new coffee shop, and it wants to join the public market.
So first, the coffee company has to show itself off to big professional investors. And if those investors think, hey, this company has real potential, they'll agree to sponsor its debut on the market. Once it launches, then anyone, and I mean anyone, including you, can buy a stock, which actually makes you a part owner of that business.
This huge debut party has a name. It's called an initial public offering, or you've probably heard it called an IPO. That's the big moment a private company officially opens its doors for the public all around the world to invest in it.
All right, so the company's public. Now what? What makes a stock's price bounce up and down like a seesaw? Well, it all boils down to two really simple forces: supply and demand. Let's go back to our coffee company. Imagine it's a runaway success. The coffee is incredible, they're opening new locations everywhere. Naturally, more and more people are going to see this and think, I want a piece of that action. They're going to want to buy the company's stock. And this creates a very simple dynamic. When more people want to buy a stock than want to sell it, that high demand literally pushes the price up, which is great for anyone who already owns a share. But of course, the reverse is also true. If people start losing faith and selling off their stock, the price plummets.
And this is exactly why the company itself cares so much. A rising stock price isn't just about making investors happy. It actually boosts the company's total value, which then helps them fund new projects, hire more people, and just keep on growing.
But this is where things get a little more complicated. A company's success, believe it or not, isn't the only thing that affects its stock price. The market is constantly being pushed and pulled by countless outside forces.
I mean, just think about it for a second. For our coffee company, what if the price of coffee beans suddenly spikes? Or a new law changes trade rules? What if the CEO leaves, or there's some bad press? All of these things, and a million more, create noise in the market, which makes it super unpredictable from one day to the next.
And when you get right down to it, all of this noise points to one fundamental truth. The market is driven by human confidence. That collective feeling, or lack of feeling, has the power to create massive economic booms, or to trigger devastating financial crises. It's an unbelievably powerful psychological force.
And this deep unpredictability is precisely why most financial experts advise against trying to get rich quick by timing the market. It's just too chaotic. Instead, they champion reliable, long-term investing, which is designed to ride out all those daily ups and downs.
But the story doesn't end on Wall Street. In the last few decades, something truly monumental happened. Something that brought the stock market to, well, pretty much everyone. You guessed it, the internet. It completely changed the game. All of a sudden, those high walls that kept regular people out of the market just crumbled. Everyday folks got the power to buy and sell stocks with the click of a button, right there, alongside the big institutional investors. So, what does this actually mean for you? It means you can easily trade stocks. It means you can directly support businesses and ideas that you genuinely believe in. And you can use the market as a tool to help you chase your own financial goals.
So, from 17th century shipping companies to an app on your phone, the stock market has always been about one thing: funding ideas. It's this giant global ecosystem built on risk, potential, and human confidence. So now that you know how it all works, it really just leaves one question. What idea would you invest in?